All right, if you have your S&P 3000 hats, you can proudly wear those hats now. I know you've had them waiting for a while. We finally crossed through that threshold today. Are we overextended? Have we gone too far? Have we kind of exhausted this bullish move? I'm going to break that down today. There's a lot of indicators out there, especially with the FOMC kind of talking about today. I mean, it's are we going to cut when we shouldn't cut, especially being at all-time highs? Is there precedent for this? What impact can that have on market expectations? I break all that down, so make sure you watch, as well as our trade idea on a stock that's kind of been a little bit forgotten, popular stock, but had a nice little breakout move here today. So let's go ahead and get started. Today is Wednesday, July the 10th, 2019. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Again, you can see we remain in this nice bullish pattern of the green line being above 80, which gives us the dark green shading, the rising moving average, which gets us the green line, and then now a rising market sentiment. As you can see, it's starting to roll over. In fact, the Dow Jones Industrial Average has that same combination. The NASDAQ Composite has that same combination. And we're still missing it. We're missing the rising moving market sentiment on the Russell 2000. And it actually happens to be below 50, whereas all the others are above 50. So that's the last component. And really probably need to get above 60, excuse me, before it can really get going here. Going back to the S&P 500. You can see the near-term line is bounced up above 50 now. So now, again, we have a bullish trend. We're looking for confirmation of that trend or any signs that we might change. That trend might change. So what we need to see is that near-term line get above 80, number one. And number two, to stay above 50, 7 to 12 days. And we didn't quite get there on this run. We had, I think, 6 days here. It'd be 1, 2, 3, 4, 5, 6... and then on the 7th day we dropped. So yeah, 6 days. We did get a bullish low point, which is the near-term line dropping below 50, staying there only 1 to 3 days, and staying above 20 with a corresponding higher low on the chart. So we'll keep our eyes on that. We obviously got above 3,000 again here today, up to 3,003 at the high of the day, closing 7 points below. So we'll keep our eyes on that heading into tomorrow. But that's about as bullish as you could possibly have. 52-week highs on the S&P, the Dow, and the NASDAQ Composite. Obviously, we're not anywhere close in the Russell 2000. 1999 was another big year where the Russell 2000 was this much of a laggard behind the S&P. Eventually that led to a bear market in 2001, through 2003, the beginning of 2003. But 1999 was also one of the most bullish years that we've had in the markets, of course, with the internet bubble and heading into Y2K and all the capital expenditures that led to that. So not saying that we're heading into a replication here, a duplication, of 1999. But you can see we don't need, there's precedent for large cap stocks to really lead, and especially large cap tech stocks. Which is what we've seen. Another thing that kind of stood out to me, I posted this on Twitter. So again, if you're not following me on Twitter, I'm at DavidSettle42. Just click that follow button that you see there. But I posted this out today. I quote tweeted this. This idea that the fund flows last week was the fourth biggest that we've had since 2007. What were the other 3 times? Well, early 2008, that led to a bounce. Late 2008, which is at the worst of the credit crisis, that hit that low point there, and then we diverged with this early 2009 low. 2011 at the worst of the credit downgrade in the U.S., and then at the early part of 2018, where we set the low point in this area and then bounced off of it. And you can see the dip here. Below at the end of 2018, beginning of 2019. So you can see essentially that the money comes out of the markets at pretty much absolutely worst time for those that are taking their money out, because that eventually sets the low point. It's a sign of a low point being set and usually leads to a rally. In this particular case, we don't have a low point. We actually have a breakout point here. All this money has come out as the market is reaching up to a breakout high, and suggesting that this little breakout move might last, that might have some legs here. And of course, that's, when you're looking at the market sentiment line being above 50, you're looking for 6 to 9 months, and that's kind of the normal range. So that would be August to November, according to this break above 50 here in February. And of course, we've had a pullback, but we're still above 50. So that puts us, another month, another 1 to 3 months, which is essentially this current intermediate run that we're on. But of course, that's kind of the norm, the average, and we can go beyond that, as we saw essentially back here during this market sentiment rally that we had coming out of the election, going all the way into early part of 2018. So we had over a year of a market sentiment with multiple intermediate rallies, 4 of them on that run, and we're currently on intermediate run number 2 here. So more than likely we'll finish this intermediate run up somewhere around here, probably in August, September, into October, and then have one more intermediate rally into the end of the year if we're going to maintain the average market sentiment move, which is again what we'd expect. Especially, in fact, I would actually expect more on the longer end of that average because of that fund flow data that we saw with how much money has come out of the market in this last week as we are hitting these new highs. That's usually not a bearish sign going forward. That's usually a sign that we've had volatility here up to this point. And like I said, that this was the last time we've had a big amount of fund flow outflows, was here at the Christmas, that week of Christmas and New Year's, and you can see what that led to going forward from there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. It's also down below the video. That will notify you when these videos are posted. Hit that thumbs up icon down below the video too. That tells me 2 things. Number 1, you like the video. Number 2, you want us to do it again tomorrow. So it's a quick way to give us feedback. In fact, it's the only way we get your feedback. So let us know what you think. You can do that right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? That lets people know who are coming for the first time why they should check it out as well. Join our daily Market Outlook email list. There's a link popping out right there in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter, as I showed you before, for more content in between the videos from day to day. And then join our Market Outlook community that we've created on Facebook. We also invite you to subscribe to our website. If you're watching our blog on our site, just hit underneath Join Market Scholars, hit that icon that takes you to our subscribe page. It's free, really easy to do. Subscribe to our site. That allows you to participate in our Market Outlook forums. We also invite you to engage with us on social media. We try to make it really easy for you to do. Click this heart that will like today's Market Outlook tweet. After this this window pops up, there'll be a like button there. You click on that button, that will like the tweet. Click on this image, that takes you to your Facebook account, and you can like today's Facebook post there. Again, the more you engage with us on YouTube and on Twitter and on Facebook, the more those social platforms will continue to deliver our content to you. That's how they know you want our stuff. With all the accounts that people follow, the way their algorithms are set up, they will show you the stuff that you engage with the most. We try to make it really easy to engage with us here on the post itself. Of course, our classes are right here. This is for our premium subscribers, but you can kind of get an idea if you click on View More what classes that we offer here at Market Scholars. All right, back to the charts. Let's take a look at the long-term view. Oops, long-term view, not that one. Now it's going to take a minute to load up here. There we go. All right, so you can see, we're getting new highs. It's a very small range this week. We're only 2 days or 3 days into it. But we're getting a small range. It's very typical of summer months. Summer months tend to have very, very small ranges. So keep that in mind. The Hakinyashi candle is not a small range. As you can see, we did get a new upper shadow, which is one of the things we're looking for, and then avoiding the lower shadow. That confirms the bullish trend that we're on, and that we maintain it. You can see the 50 and the 200-day moving averages are rising. We're above both pretty easily. The momentum is rising, so the gap between the two are rising as a function of the 200-day moving average. In this case, the 40-week moving average. So bullish across the board there. And then you look at the 3 green arrows we got 3 green arrows and a rising moving average. That's pretty bullish as well. You take a look at the 3 green arrow chart, the 2-line versions of the chart, and you can see how we're above the 8-day moving average. It's rising. All 3 are rising. The MACD is relatively high. We've already had the surge, so don't look for it to go, significantly higher if it does at all. It typically grinds towards 0 as we trend higher after that initial surge. So we've had the initial surge. The stochastics is still in the upper reversal zone. The average here is in the upper reversal zone. So buyers are easily in control here according to the stochastics chart. All right, so we look at the intraday chart, and you can see, we got a new 4-week high point today on SPY, so almost the 300. Pretty decent little jump in volume here. We filled in most of the gap, not all of it, but most of the gap there. We finished below last week's high point, even though we did finish above yesterday's high. So, that I mentioned yesterday, at least I mentioned in class yesterday, that when we gapped down, that we were more likely going to fill in that gap, and we did, right? So, that's fine. But there was also this gap here too, and the only way that this doesn't get filled in is if we start a really bearish move here, which usually accompanies a jump in volume, which we didn't have. So we were, at part of that class discussion yesterday as well, was that we're most likely going to fill in that gap too, and we did today. Now, we gapped up through that, but you get the idea that these common gaps get filled in, just like today's did. Even though we gapped higher, we pulled back, and these gaps get filled in, and that's where we are, and we expect that we'll continue to move higher here. In fact, if you take a look, right now we have about a 12-point difference in the 4-week range. 5% of 300 is 15 points, so we actually still have some room to work with to the upside before we get too extreme to the of a move to the upside, kind of an exhaustion type move. And you can also see too that within another week or so, this low end is going to move up here to this 290 area. So we'll have a 10-point range plus whatever else we might move up higher. So that will even give us more room to work with, and that will be there for a few weeks after that. But you can kind of see, we have some room to work with to the upside without getting too aggressively bullish to the point where we've exhausted ourselves. And you can see here's the Heikin Ashi Open for this week. We're well up above it, nowhere close to touching it. Same thing with the 4-week midpoint. Now that 4-week midpoint is going to gravitate up a little bit, and when we do move up, when the low point does get up here, then it'll be right around this 295 area, so move up a little bit more. But we're easily in the top half of the range. We're easily above the Heikin Ashi Open. We're nowhere near, touching. I mean, there's a lot of bullish patterns here, and none of them suggest extreme moves to the upside, at least not yet. If you take a look at the volume and the trading range today for SPY, and again, you can see the volume was 58 million, was about average. The average is really low, as you'll see here in a second, but 58 million, the range was just over 2 points. Keep in mind the gap. So we closed at 297.19. The low point today was 297.78. So you got to put on about another 0.6 of a point to that. So you're looking at about 2.5 points. So the range was about average. The volume was about average. And you put that in context, the range is really low, and the range is well below 1%, so great. And then the volume is also really low relative to the 52-week range. So bullish volume and trading range, to say the least. And then finally, you look at the volatility. A little discussion today about volatility getting crushed. And keep in mind, volatility did drop today. That's a pretty decent move, but the range today was only 1.71 points. It's a little bit above the average. The biggest issue was that it dropped below 90% this morning, and it's pretty entrenched down there. That's a very, very good sign for volatility, because again, getting below 90 and staying below 90 is what you want to see when you have an established bullish move. And you can see it way over here how long we stayed down there. So getting below 90 and staying below 90 is the bullish range for volatility. And today's move was a nice breakdown. And I don't expect we'll get down to 10. We might get down to 11 or 12. Keep in mind that there's a lot more room to the upside than there is to the downside. There's very, very limited range. So shorting volatility in terms of directionally bearish trades on volatility itself, there's other ways to be short volatility without necessarily shorting it directly. But there's not a whole lot of room to the downside. We might, we're below 15, and now we're below 90%. That's bullish. That means that the trend is entrenched now. Very good sign across all these indicators that we're bullish now, and we can expect to be bullish here for a while. All right, so now's your time to vote on that. Click that link that's popping out in the top right corner of your screen. It opens up a poll. What do you think? Do you agree with that assessment, a technical assessment of this bullish trend and posture we have going on and the expectations going forward, or do you disagree with that? If you click disagree, comment down below on what you're seeing that would suggest that we shouldn't be this bullish, that we should expect stocks to be dropping here pretty soon. For whatever reason. Of course, people have their opinions, and if you have a lot of bearish trades on, you're probably hoping that the markets will go down. But if you see something that would suggest that the markets here should be more bearish in the short term to intermediate term, share that with the community down in the comment section below. All right, now let's talk about what's driving price action today. Of course, the biggest news today was the FOMC testimony and the impact that that's had, put pressure on. Oh, here, let's move this up here. There we go. Put pressure on the dollar. I also put pressure on bond prices, kind of a sell the rumor, buy the rumor, sell the news kind of a thing. You can also see, too, that the dollar is actually pretty strong over the last couple of weeks going into today, so it has some gains to give up. That's helped the U.S. stock market outperform, and you can see small caps have been outperforming over the past couple of weeks. Obviously, that's more of a recent phenomenon, even if it didn't outperform today. Emerging markets and foreign stocks are down here, down below the U.S. stocks because of that strength in the dollar. But again, when I look at just today alone, here let's go to today. Just today alone, you can see the big moves that we've had. Again, all kind of related to this weakness in the dollar. In fact, everything else is relatively flat in comparison, except for these dollar-related asset classes. And you look at crude oil being, a reflection again of inflation expectations and economic growth expectations. And you can see it broke out above this high point here today. The intermediate line is strongly bullish. The green line is now moving higher. And its market sentiment is rising. So crude oil has that bullish combination and coming off those low points. And you can see the 10-year note also starting, it's down from where it started the day, but it's also higher with this intermediate line finally turning weakly bullish. Of course, and nowhere close yet to that bullish combination here, but it's not bearish anymore either. And that's a positive sign. You can see TLT, which is the long-term bonds, not the 10-year, but the long-term bonds, it's turned bearish. Its intermediate line now crossing down below market sentiment. And, it's done this before. It doesn't necessarily mean that we're going to start a bear market, but it does slow down the bullishness that it's had. And then finally, that dollar index, as bullish as it was, it's a pretty bearish move that we had today, closing below, engulfing really the last 2 days worth, and strong bearish short-term sentiment you would expect to lead to a bearish high point on that intermediate line. That would be bearish, like this one was when it gets above 50 and peaks without getting above 80. Makes a run here. This one eventually got up to 80. You can see here we got a couple times up to 80, and we continued to trend higher. But this last intermediate peak, after rising above 50, did not get above 80. And now we might get the same thing. And of course, it'd be a lower intermediate peak than the last one, and that would be bearish for the greenback. And of course, again, if you want to know the ramifications of what that would mean, there is gold getting a cluster. This is today's future, so we're not quite in that. This is today's move that we had for most of the day today. Gold is breaking out. In fact, if you look at the long-term view here for gold, you can see it's a pretty decent breakout a few weeks ago, obviously, and some long upper shadows the last couple of weeks. Don't buy into this bounce initially until we break up above 1443, right? That long up, the highs of these long upper shadows can act as a resistance level. But that's a ramification for weakness in the dollar, and of course strength in emerging markets. Emerging markets really close to getting the golden cross, the 50-day crossing up above the 200-day, as what reflected down here on the PPO. So, again, that would be a positive development for, an asset class that's really been lagging behind, but it's been lagging behind because of the strength in the dollar. So, of course, also weakness in the dollar would also be bullish for stocks just in general. So, another sign that we can expect to be bullish here. If you take a look at the sector rotation, I brought this chart up before, and again, I put out a few things today. One of the things in particular was why the Fed. There's a lot of chatter about, does the Fed should the Fed raise? Do they have the data to raise rates, especially with jobs that were so strong? But keep in mind, that's only one economic indicator. All the rest of the economic indicators have been falling compared to their estimates for pretty much since last summer, since about August. We've been falling. Brief moves to the upside, but for the most part, it has not been a good economic environment for the U.S. pretty much since last August, September. Not that we are in recession, but the indicators have been coming in below estimates. They've been, especially the year-over-year growth rates, have been falling. So again, not below zero, but they've been falling from their peaks that they had. You can see inflation expectations. So here's that October, peak that we had in the markets here. There's August, and you can see how much lower we are now. Again, the Fed raises rates to keep inflation expectations in check. Well, they raised rates after we were already coming down, and then we continue to go down. And then the other thing I wanted to bring up, besides the fact that the yields here are so much lower than they were in October, is this idea of the euro. This one. The euro has dropped compared to the dollar from 118 right around that September-October level down to 111 since then. Remember, the Fed raised rates here in December one last time. Well, that drop right there, and that's what I tweeted out here, that drop from that high to low on this one-year chart, that is during this period of falling inflation expectation, falling crude oil, falling economic indicators, falling yields, falling everything, falling stocks everywhere else but the U.S., right? Look how far down all these other equity markets are from their January 2018 highs. They're all down so sharply. Russia is back close to its highs. Brazil is closer. Everything else isn't close at all. France isn't down as much. India isn't down as much. But you get the idea. The U.S. stock market is well above its January high point. So, and that was something that Josh Brown mentioned today on CNBC, that we don't get recessions from over there. We give recessions. When we give recessions here, then everybody feels it. But if they're in recession, we don't necessarily get it. And that's a good chart to show that. But that move in the euro here, when everything else is falling except for U.S. stocks and bonds for that matter, if you were to trade a mini contract in the spot Forex market and short that contract from high to low, then you would have generated over $700 of return on a $225 investment. So, that $225 investment essentially becomes $1,000 in just 8 months. So that kind of gives you an idea of just how significant that move was. The dollar strength there that's reflected in that move is tremendous relative to the euro in particular, and that's pretty much its main rival outside of the, obviously the yuan with the trade deals. So the fact that there's plenty of data points that would suggest that the Fed should lower interest rates, and that's what the market got today out of the testimony, was they most likely are going to do that. And again, as we saw in 1995, when the Fed raised rates in July, or cut rates in July, and then again in December, then again early in 1996. That was coming off a really big, of a rate hike cycle that the markets thought they went too far. Even though, in 1995 we were at all-time highs, we had a really good first half of the year, very similar to this year. This 2019 is shaping up to be very similar to 1995 in that we've been pretty darn bullish, and that we're anticipating the Fed to do 1, maybe 2, maybe 3 rate cuts to offset a policy that the markets feel like was mistaken, that they raised rates too much in 2018. From a sector standpoint, obviously you can see the cyclical sectors, especially financials, are starting to work their way through. If we just looked here at today, there we go. If we just looked at today's move, again, in context of this idea that that the dollar dropped, that that we're having this kind of rate cut sensitive move. You can see industrials and materials didn't rally on that weakness in the dollar, but energy did. So big, strong move in crude oil. Energy's got the biggest move to run out of all these sectors. Communication services, technology also rallying. You can see some of the safe haven areas, utilities, and real estate rallying as well before falling by the end of the day, and there's discretionary there. So going back out to the 2-week time frame, here we go, I'll be right here. Going back out to the 2-week time frame, you can see again communication services and real estate, interest rate sensitive components of communication services doing really well. Cyclical areas holding up too. Financials doing really well. Financials and energy were kind of 2 of the more beaten up sectors that we have. You can see here that our best performers, according to Brandon Sector Selector rankings, are technology, healthcare, and financial sectors. So financial has been such a lot. I mean, look at all that green and red that it's had here, in addition to technology and materials. Some of these others, especially healthcare and utilities and real estate, kind of held up well. But financial struggled, and it's close to its 3-month highs. Technology is at 3-month highs, so is healthcare's close. Communication services getting an overbought cluster. You can see discretionary getting up to new 3-month high points. Real estate close, staples close, utilities. I mean, industrial starting to work its way back up again with a very, very weak bearish posture, mind you. But energy is the one that's struggling. It's got the most to run. They're all now, you notice, all the industries have rising moving averages. And beside from industrial, strong bullish postures above 50 and rising, or above 80, even though some of these are falling up here, they at least are above 80. So very, very strong bullish move across the board. Remember, as we get more bullish, then you start to see more divergence, right? You start to see some continue to do well and others show pink and red lines and yellow lines. So we're not to that point yet, right? So when we're really going bullish, then they're all kind of showing the same patterns. And aside from, again, just a weak, about as weak of a bearish posture as you can possibly have in industrials, everything else is looking, they're all looking pretty close to each other, pretty close to the same patterns here, those strong bullish patterns that we like to see. All right, one of the stocks that's in this discretionary area that's had a really good day today actually was Tesla. Breaking out today, you can see the momentum line getting up to an extreme. The intermediate posture is already strongly bullish, combined with the dark green line, the green line on the moving average, as well as rising market sentiment. After a near-term pullback, that's a pretty good bullish pattern here. It was kind of stuck with some bullish near-term lows and bearish near-term highs, but then today kind of a little bit of a breakout from a near-term perspective, near-term line perspective, a little bit of a breakout today. So a positive development there for Tesla when you look at its 3 green arrow chart. Obviously we have 3 green arrows now with the stochastics turning back up here. The MACD has been relatively flat. When you look at the 2-line versions here of this line, you can see it hasn't really had the big surge. It had a move off of some extreme lows, but it hasn't really gone up to, a good surge to the upside like we've seen on some of these. So there's still room for it to run, and the stochastics you can see is above its moving average. Both moving averages are rising, mind you, on that chart. If you look at the Bollinger Bands, you can see that we're below the value area. There's some room for Tesla to run up here towards the upside, towards this kind of next layer of resistance right around 275. I bring this up because if you look at the long-term moving averages, the 15 200-day moving averages, you know, when they're so extended like this and you break up above the 50, it tends to fill in that range. If not eventually get above the 200, at least come in and fill in that gap between the 15 to 200-day moving average. And you can see from a, you know, if I were to look at the context over the last 10 years, the stock right now has as much bearish momentum that it's had. So it's been pretty bearish, and we've had a nice good engulfing pattern there. And like I said, getting back up to and now through the 50-day moving average, that 200-day moving average is right around this 265 level. So if I come back here and I look at the Bollinger Bands and say, okay, well 265, you can see, whoops, let me zoom back out. 265 is going to be right into about this area, right where that volume node starts. So you can see how significant it would be. Not only would it run up towards the 200-day moving average, but it would also run up towards its next volume area. So there's opportunity for Tesla to be bullish up until that point. And you can see there's some, you know, there's some volume now below us. We didn't have that. We hit this low point, we bounced. We're in the upper half of the Bollinger Bandwidth. We're pushing up above. We closed above the upper band with the bandwidth starting to rise again. So when you look at the DMI too, you can see the negative line crossing below 20, positive already easily above 25. So an opportunity here for this bullish trend to really develop with the ADX already above 20. So that being said, we take a look at the options. Again, we've got resistance, right? So we don't want to be aggressively bullish. We don't have a long move that we can make out of this. But we can sell that 225 put at the 34 delta by the 220. And that gives us enough credit. If you take a look at the, you know, analyze this trade, go onto the risk profile here, and let's go to the single symbol. Set the slice to break even. Put this on 817 up here so you can see it. So you can kind of see, you know, how far it can go up. Remember, you've got resistance right here at 265, which is great because if we can get the first half of that, if we can make that move and get the first half of the max gain here as it gets to that point, then take it, and then we'll move on to something else. And if I were to put the break-even slice onto the chart itself, knowing that we can risk, you know, 150 bucks. Whoops. Let's try this one more time. Slice it to the chart and we'll move it here. Then there's where our chart is. So to show you what that looks like here on the 4-week range, basically as long as it stays in the upper half of its 4-week range, then you're bullish. Once you start to get below the lower half, then we'll get to the point where we'll have the, you know, roughly $150 loss that we'd be willing to take. Really, it'd be all the way down into this area by the time we get to $149 loss. 146 there. Let me just make sure that that's the case. Yep. So 146, and of course that's going to change as time passes. But you're looking down to 210. You know, that's all the way down to the lower end of the range. So we've got a lot of room to work with for this to make a move up towards 265. If it does soon, then we'll grab that gains. If it stays above 225, which is the midpoint of the 4-week range, then we can wait it out, right? As long as it stays above that level, we can wait it out and get that full maximum gain. So an opportunity to be bullish in a stock that's in a cyclical area that's had its own little bullish move today, a little bit of a breakout gap to the upside and closing at the highs. So making, you can see kind of with a little bit of a jump in volume, making this one of those type of runaway gaps here where less likely to be filled in and more likely that we continue to move to the upside here for a while. All right, so that wraps us up for today. You've heard from me. Now I want to hear from you. Use that link that takes you to our Market Outlook forums at marketscholars.com. Open up any new thread with any questions or comments you have about today's video. I'll be able to answer them there. Also, remember you can reply to anybody else's thread. If you have any questions or comments on anything I didn't discuss in tonight's video but relates to the topic, make sure you open up a new thread about that too. But let's keep this conversation going between now and our next video here tomorrow. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between videos from day to day, and then join our community out on Facebook that we've created, as well as on marketscholars.com. Have a great rest of your evening, everybody, and we'll see you all next time.